All right, let's begin. So namaste everyone, and good evening from warm Melbourne, which is a rarity. And let me start by acknowledging the traditional owners of the land on which we meet, the Wurundjeri people of the Kulin Nation, and let me pay my respect to their past, present, and elders. And now, on behalf of IG Funds, I'm delighted to welcome all of you to the Shubh Diwali Symposium, Accelerating India-Australia Investment Opportunities via GIFT IFSC. And of the ones who attended our previous events when we caught up in September, I started with the theme of hope through the start of spring, and continuing that trend. This one is on prosperity, wealth, and new beginnings. And I'm very fortunate to have so many leaders and investors join us to explore how GIFT City is opening new bridges between Australia's capital and India's growth story. And today we are really honored to be joined by distinguished representatives from Indian High Commission, IFSCA GIFT City, NSC, HDFC, AMC, DSP Mutual Fund. We've got Australia India Business Council speakers here as well. So we've got a really full-on agenda, and it will be very insightful, I'm sure. And we'll talk about how the bridges are being mapped up now and how it's accelerating as we gather momentum. And on that note, I will probably start with Mr. Chirania, who's from the High Commission of India, to probably start the symposium. So welcome everyone.
Thank you.
Harshad, over to you.
Thank you. Good morning to everyone in India. Good afternoon to everyone in Australia. Namaste. I can see Irfan, Malik from AIBC, Dr. Dipesh Shah from IFSCA, Rohit, Mandhotra from NSC, Aravind, Rengarajan from HDFC, AMC, Kothari from DSP, Harshad Bhai from IG Funds, all other participants, ladies and gentlemen. First of all, I'd like to thank the IG Funds and Mr. Kale especially for organizing this and giving me an opportunity to speak. There was some reluctance on our part at the beginning, but the relentless pursuit by Mr. Kale, kind of brought us to become a part of this event. Before I begin, as we are doing this on eve of Dhanteras and a few days away from Diwali, I wish everyone a very happy Diwali. Diwali, as Vipin was saying, is festival of prosperity, of wealth, and it also symbolizes the triumph of light over dark, good over evil. I think in many ways it mirrors our bright future between India and Australia. It is eliminating pathways for collaboration, growth, shared prosperity, mutual well-being, and so on. So I have been told to speak about India-Australia bilateral relations in the field of economy and trade. I'll also be speaking slightly about India's own growth story and what the government is doing to make India a more attractive investment destination. And I'll also speak about the role that our High Commission is playing in that. And that will be broadly the extent of my remarks today. So, ladies and gentlemen, the economic ties between India and Australia have never been, stronger. The progress we have made in recent years is nothing sort of remarkable. In 2022, we signed the ACTA, which is our Economic Cooperation and Trade Agreement. Since then, our trade in merchandise, bilateral trade in merchandise, has almost doubled. In last financial year, it was Australian dollar almost 50 billion Australian dollars. What it reflects is not just a growing number of exporters and importers benefiting from it, but it also reflects the deep mutual complementarities that we have and which defines our partnership. Australia's strength in resources, technology, innovation has perfect synergy with our own, vast market, large, I think the largest skilled workforce in the world, and a dynamic economy. We have, a very young population which is driven, and Australia has a lot of natural resources which we can convert into useful things. Um, I if I take an example, renewable energy and new and emerging technologies in that arena are a perfect example of that. Um, Australia has vast reserves of world-class critical minerals, and it has expertise in renewable energy technologies. Many of the universities in Australia have led, many of the technologies that today form the bench, the basis of our renewable energy efforts around the world, including the solar panels and so on. And we have ambitious goal in India for renewable energy targets. We also have a large ecosystem that supports the manufacturing of batteries, of solar panels, and so on. And there is strong mutual complementarity in that, which I think is yet to be realized to its full potential. We are also, in the process of negotiating our comprehensive economic cooperation agreement, SECA. We have done 11 rounds of negotiation, the last one being in August in New Delhi. And hopefully we'll very soon achieve, an agreement. In any case, Indian products, under 100% of tariff lines in Australia, Indian products, have enjoy 0% tariff. That is about 75% to 80% for Australian products. The SECA will, it'll open further doors in mobility, in services, in digital trade, in investment. These all our bilateral economic ties. They emerge from a shared bedrock of democratic values, commitment to rules-based international order. We are together in forums like Quad, and our economic relationship goes just beyond economic ties. It is a part of an overarching comprehensive strategic partnership, of which I think our Indian diaspora, almost 1 million strong, form a very important part of. This symposium organized by IG Fund could not be more relevant, as India's hunger and appetite for investment is growing day by day. We are on a transformative economic journey. We are poised to become a $5 trillion economy by as early as people say 2027. Projected to hit 7 trillion by 2030. We are already the fourth largest economy and soon to become the third largest. We have clocked over 7% GDP growth almost every year, barring the COVID years. Even amid global challenges like the two conflicts that we are seeing and supply chain disruptions and so on. We have been in many ways, a beacon of hope, beacon of stability in a turbulent global economic outlook. A lot of which many of the countries are not responsible for themselves, but are facing. What does it mean for the Australian investors? For Australian investors, it means a reliable, safe, high growth investment opportunity. It also means partnering in a process of almost 1.5 billion Indians taking on a transformative journey. We are we are rapidly growing, and our needs of infrastructure, or our needs of consumer goods, our needs of high quality services are rapidly growing. And this provides unparalleled economic opportunity, in terms of geography and history. Many people rue the opportunities that they missed in a certain northern neighbors of ours. I say you have another opportunity in that regard. In infrastructure, our national infrastructure pipeline is channeling 1.4 trillion US dollars into roads, ports, railways, and digital networks. Last year alone, we added about 13,000 kilometers of highways. In renewable energy, we have set up a target of 500 gigawatt capacity by 2030. We have a target of 5.5 million tons of green hydrogen production. We have a critical minerals mission, which is, we have, for which government has allocated almost US dollar 5 billions. So there are all these investment opportunities. But if we zoom in on the financial landscape, we have representatives from GIFT City. This has emerged as a global hub for cross-border financial activities. I'm sure Dr. Dipesh will elaborate on this. For Australian funds and businesses, GIFT City, it provides a structured, tax-efficient vehicle for investing in India's high-growth sectors, especially in mutual funds tailored for long-term capital growth, as IG Fund is pioneering in Australia. I'm so sorry. My phone is connected to my laptop, and so can you hear me now?
Yes, we can.
Yes, thank you. On asset management side, our asset management industry is exploding. Companies like HDFC, they are alone managing over, I think, almost $150 billion worth of asset. We have a booming stock market. NSE is the world's largest derivative exchange by contract traded. Our middle class is growing. We have 450 million strong middle class now, which is projected to reach almost 800 million by 2030. This is driving our demand in consumer goods, fintech, e-commerce. We have received over $1.2 trillion worth of foreign investment. It was more than $80 billion last year alone. So this is a testament of global confidence in India. And none of this growth is happening by accident. It is being fueled by a very proactive government. Under the leadership of Prime Minister Modi, the government has implemented sweeping reforms. The recent rationalization of GST rates just being, one of them. We have PLI schemes across 14 sectors, including semiconductors, solar modules, EVs, and pharmaceuticals. This is set to generate almost $450 billion worth of output and create 6.5 million jobs. We have, the government has slashed the corporate tax rate for new corporate entities to new manufacturing units to 15%. For other units, it's 22%. This is on par with any developed global economy. We have eased FDI norms in sectors like defense, space, e-commerce, and several of these areas now have 100% automatic route for investment. This government, since 2019, has eliminated over 1,500 outdated regulation requirements. UPI and GST, offer a global level digital services platform for our startups. We are focusing very rapidly on Skill India mission, with a target of upskilling almost 450 million workers by 2027. So, as the representative of High Commission of India, I just want to say that India is ready for business, and India is ready to for your investment, for you to provide you an opportunity to where you can see your funds grow and grow rapidly. I don't think there is this opportunity window is available anywhere else in the world. The High Commission of India in this regard, stands fully committed to playing a central role in supporting any potential investments into India. We have not just the High Commission, we also have consulates in Sydney, Melbourne, Brisbane, and Perth, and we want to serve as your bridge to India. We are ready to facilitate connections with Indian policymakers, businesses, regulators. We are ready to provide tailored guidance on market entry, regulatory navigation, and partnership opportunities. Whether you want to take a business delegation to India, or whether you want to organize a webinar like this one, or you want to have one-to-one consultation, High Commission of India here in Australia and its consulates, and the government of India in New Delhi and in the States as well. We are ready to have that conversation. We are ready to provide our support. Just yesterday, Irfan is here. We were at Australia India Business Council's annual gala dinner, and there was a delegation from Bangalore, the IT department of Bangalore, and the secretary herself was leading the delegation and reaching out to potential investors and giving assuring all kind of supports. So you can see how proactive our even our state governments have become. In next few days, I think I was getting complaints from AIBC officials that there are too many delegations. As far as I know, at least 4 to 5 state delegations are coming to Australia in just next week alone, seeking funding, partnerships, collaborations, and so on. We recently had the Minister of Skill Development come to Australia on a tour and seeking to take up best of the practices for our skilling institutions in India. So, this is my pitch basically. That as as the first secretary looking after trade, commerce, and economic relations, I also see myself as the chief marketing officer of India, and this is my pitch. That Indian government is ready, and we are ready for your investment. Please explore the opportunities. And in closing, I would like to thank IG Funds, for creating this opportunity for the retail investors of Australia. As we celebrate Diwali and look ahead, I welcome all potential investors to seize this moment to accelerate our shared prosperity through GIFT IFSC and beyond. Thank you.
Thank you.
Thank you, Harshi. It was very insightful and giving you a highlight of how CEA and all the in Australia India trade and investment is all about, and the ties. From the heart of the whole financial innovation that's happening and positioning India into the global scenario is Dr. Dipesh Shah, Executive Director of IFSCA GIFT City. Over to you, Dr. Dipesh.
Yeah, thank you, everyone, and in particularly to my colleague in the High Commissioner of India in Australia. Thank you for that opening remarks, and we really see a great support from you while during our several visits to Australia. I think the type of the investment scenario that we are seeing from the excitement from the Australian investors has been very high. I must congratulate India Growth Fund for organizing this very important webinar. I think investing into India is always a big opportunity, but it also has a lot of apprehensions in terms of how do I navigate the whole investment. I think that has always been a challenge, and probably some of the structures evolving in GIFT City is probably becoming an answer to this, uncertain way of investing into India, and then getting challenges in terms of how do I file my tax returns and how do I undertake my return back to Australia. So all those, I'm sure, answers would be provided in this webinar today to the investors present here. Let me, from my side, I have been given 10 minutes. So let me try and stick to 10 minutes because I see a lot of experts on this panel after me going to speak about their experience and the way that they see Australia India investment. So I'll stick to 10 minutes allocated to me. But let me briefly tell you about what the government of India has done with the creating a new investment route into India. I think we all are aware of coming into India, investing directly into, say, Mumbai, through Delhi, through any other places. We have seen that route. It is available to all of you as we speak. But that route has always been under discussion in terms of, is it a very smooth or is it a very easy way of investing into India? Or do you need structures which is more convenient for the foreign investors? And I think that's where probably some of the smaller centers, as you see in Singapore, Dubai, Mauritius, created as very easy platforms to invest into India. And probably GIFT City now, with the vision of the government of India of creating its own offshore center into onshore India, is probably becoming an answer to this whole problem statement of how do I invest more efficiently into India, using the probably a GIFT City as an offshore center into India. Now, when I say offshore center, what does it mean for investors on this call? For them, probably this must be a mystery as to how it is an offshore center. The GIFT under the Foreign Exchange Law of India has been declared as a non-resident zone, which means when you invest through GIFT into India, you are outside of Foreign Exchange Law of India, which gives you a parity in terms of whether you are investing from Singapore or you are investing from GIFT into India. It has a similar parity for you to invest into India. That is number one. I think number two, when you invest, you also need a regulatory framework which is more conducive for the investors to invest into India. And under this scenario, what government of India did was to create an offshore regulator within India. So now we have two systems of regulation. One is you have a Security and Exchange Board of India, Reserve Bank, the insurance and the pension regulator in domestic India. And now government of India has created an International Financial Services Center Authority, which is an offshore regulator within an offshore center in India. This is now a new way of, as I said, creating a new platform to invest into India. What does this authority, where we are right now representing ourselves, what we do? We created a regulatory framework for Indian and foreign institutions to come and create a platform. We provided them the regulations which are in line with what probably you are finding in Singapore, Dubai, Mauritius, any other financial center. You find a similar or a better regulations within the India's offshore center now in GIFT City. And what does this translate into for people on this call is that you are now able to see for the investment managers, the funds, the mutual fund managers, all sitting in GIFT and bringing in money into India through GIFT City. So when we say bringing money into India and invest into India, how does it operate? You as an investor in Australia, you come into the GIFT City regulated entity structure. So for example, we have registered 300 funds right now in GIFT and almost 190 plus managers we have registered in the IFSC zone with the potential to invest more than $25 billion into India and outside through GIFT City. What does this manager do? This manager in turn would go and solicit business within the Indian ecosystem for allowing the Indian residents to invest outside. But more larger opportunity is for the non-residents, which means the non-resident Indians in Australia, or for that matter, even a foreigner in Australia. How can he invest into India? Now, GIFT City structures helps them to invest in two ways. One is that you can directly come and invest into a fund in GIFT, which in turn invest into India. But in that scenario, we were finding there were challenges in terms of whether my documents, how does it travel? My KYC documents, my registrations with the authorities, how does it proceed? There were a lot of challenges and a lot of question marks when it came into how to invest into India. So what we found was, and we've been working with the Australian counterparts for almost 2 years now. I made 3 visits to Australia in terms of, understanding the problem statements. And what we found was, if there is a regulated entity within Australia, which is an ASIC registered, which is your Australian Securities Investment Commission registered entity, the investors were quite happy to come through that route instead of coming directly into the GIFT route and investing into India, for the simple reason that they are now talking to a regulated entity which is regulated by their own regulator in their home country, which provided them all the comfort in terms of the documents, how it's going to travel, what are the KYC requirements and all. From that regulated entity, the money flows into the GIFT regulated entity, which is regulated by us as an IFSC authority. And by the way, just for the information of the participants on this call, we have signed an MOU, Memorandum of Understanding, with ASIC, the Australian Securities Investment Commission. So as a regulator to regulator, we both have an MOU, which allows us to sharing of best practices and information between us. Now, this regulator structures, money coming into the GIFT regulator structure goes into India for investment. Now, there was one more problem statement. While this piece was made easier with the structures that I just mentioned, but the second piece, which was more important, was whether would it be a tax efficient structure to invest into India. And that was always a debated. And when we started working, we found that people coming from other parts of the world, they were getting some, tax regime which was not available in GIFT. So we did work with the government of India and because this is the project which the government of India has been really promoting, not only in India, but to the global investors, gave us a very important tax regime, which allows now the investors sitting in Australia to invest into your own regulated funds into GIFT, in turn invest into India, and the whole transactions become very tax efficient with no long-term, no short-term taxes to be paid within the GIFT City structure. I'm sure during this deliberation, somebody is going to present, how it's going to operationalize in terms of the investors sitting in Australia. But broadly, I think this type of structures were needed to create awareness and also give an easy access to India investment opportunities. Harshad mentioned about the India story, and I think his numbers, if I can just put some numbers to what he said. See, we are already 4.27 plus trillion in GDP now, almost touching 5 trillion as we speak. And with the next 20 to 25 years projections, not only by the Indian government, but by any global agency, I think for next 20 to 25 years, India is projected to grow more than 7% for next 20 to 25 years. Now, which economy globally can today raise their hand and say that, look, we are going to grow more than 5% for next 25 years? I don't think any economy today withstand that test of, commitment, that test of growth which India is witnessing. So that is number one factor which is really pushing people to look at India as an investment avenue. Second, I think the regulator structures and the regulation and tax regime being simplified, which is at GIFT City available now, also helps them to use this route much more tax efficiently and much more tax certain way of investing into India. And third, I think the presence of the fund managers here, I was happy to see DSP and HDFC friends here, which are regulated funds in GIFT, and now allowing the investors to bring their money into the GIFT regulated structures to invest into India. And I think this all players coming together in the GIFT City ecosystem is making the whole investment scenario quite efficient. And probably that is the reason why we all are today on this call, of making you understand how the structure works. But from the, as I said, I have 10 minutes and maybe 2 more minutes to go. I'd like to summarize by giving you some of the future perspective of what is going to happen in GIFT. So we have already crossed 1,000 plus registrations in GIFT now. There are 28,000 people who are working in GIFT City and growing very rapidly. We are 300 funds, as I said. We will be touching maybe 500 to 1,000 funds in next 2 to 3 years. And the investment in these funds committed is almost $72 billion. They already raised $24 billion. They invested $12 billion. And this scenario is going to grow very rapidly further up. Just like what India Growth Fund has done, I'm sure many more such structures will evolve as people will see the ease of investing into India through this type of structures. You will see more and more managers also adopting similar type of strategies. And from the regulator perspective, we do believe that creating an easy access and providing them an easy onboarding processes. So we are in process of issuing face-to-face, the video KYC processes to be simplified. What we are now doing as a regulator is to even further simplify the video KYC norms for people to invest into India. And for NRI, I think the IFFC is one of the best possible location to utilize, whether you want to park your bank deposits, you want to do your investments, you want to do insurance products, you want to do life investments, mutual fund investments. GIFT is now becoming an answer to that. As we go ahead from here to the next 3 to 5 years, you will see probably not only the investors from Australia, but from most of the markets globally would come through similar type of structures. One, because it is, as I said, it eases the burden of coming directly into a different country in a different regulated environment. And two, it would also ease from the perspective that they have somebody in their home country itself to go to for their investments. I think that type of comfort will probably change the scenario of the way the NRIs and the foreigners are investing into India. I think my time is almost done. I congratulate the organizers for having me today and probably for organizing this very important webinar, which I'm sure is not only the one of its kind. I'm sure this type of webinars may be required every 2-3 months to educate larger audience on a regular basis and make them understand the importance of and ease of investing into India through GIFT City or such structures. I thank you for inviting me and congratulations to everyone involved in this exercise. Thank you.
Thank you.
Thank you, Dipesh ji, for the fascinating deep dive into India's financial evolving landscape. Now we turn to Australia-India Business Corridor. Please welcome Mr. Irfan Malik, National President of AIBC, New South Wales. Irfan ji, over to you.
Namaskar, greetings. Sorry, I'm on the move between 2 sessions, but I'm glad that I can join you all. Just at the consulate of India as we speak now. But yeah, very pleased to join you all from Sydney, Australia, representing Australia-India Business Council, which is the leading preeminent industry body, bilaterally working with both the governments and various states as well to really facilitate trade and investment. We are very excited about the GIFT City opportunity and partnership. We've been hosting the delegations of various companies, but we are also actively promoting Australian companies and investors to look at India as an investment destination, and through GIFT City as the wire media for us to leverage the growing growth engine of India. So we're very pleased to be working with GIFT City and very honored that we had hosted the delegation all the 3 times recently included. But what we are very excited about is to see that the IG Fund, the India Growth Fund story being successful, but also the traction it's already seen in the last few months since its launch, the level of interest that's been seen. I have personally discussed with several aggregated funds, SMSFs, and various accounting and financial firms as well, who've been all excited to see that we have an opportunity and a pathway and a structured pathway. What is very important to ensure that we are able to handhold some of these, funds and some of these organizations here looking to leverage India is that structured offering, and having an AFSL licensed fund and with an opportunity to leverage the growth story of India is quite exciting, and we have had great feedback. And of course, we are keen to see that this scales, and also we are able to promote more and more investors to leverage through these pathways. So I'm very excited that GIFT City is supporting this initiative, and we at the Australia Business Council are very keen to also continue to help accelerate on this journey. And ourselves, we are interested to bring several companies and investors to GIFT City as well as part of this, GIFT City bridge that we are looking at building as well. So very excited about the opportunity and our support from Business Council to promote this pathway, but also to support and bridge further with GIFT City as well. So I'll wrap up on that note, and I will be available for any questions down the line anyway. Thank you again, and look forward to collaborating and wishing you all well for this very important, significant webinar here. Thank you.
Thank you, Irfan ji, for those inspiring insight on how collaboration and networking drives across the growth of border. And now welcome Mr. Rohit Mandhotra from NSE, who will walk us through how India's capital market are evolving and what it means for global investors. Over to you, Mr. Rohit.
Am I audible?
Yes,
Yes.
you're audible.
Okay,
Yes.
perfect. So thank you so much for the opportunity. I think before I start, I'll wish everyone a happy Diwali in advance. The lucky days from an Indian calendar perspective, the blissful days are starting. Now, Harish ji, Dipesh ji, and Irfan all talked about very key points, in terms of how access is to be made, what the government is doing, what infrastructure has been put in place. Now, I'm here to kind of, bridge in terms of how India's growth has happened in terms of capital markets for these years, uh, and then how the gift city has also grown, and how NSE is kind of playing a pivotal role in terms of getting more people to participate on the capital markets, and how 100% subsidiary of NSE in gift is also helping us to achieve that. So I'll quickly share my screen and just help it with the presentation. uh, is the screen visible?
Yes, it is.
Okay. So see, basically what we've seen is that India has and Dipesh ji and Harish ji also told that India has really grown over the years. If we kind of look back from where we were in 95 to what we are now, we are the fourth largest economy. The per capita income has grown, though we are not really there where much of the economies are there, but we're there. We will become a 5 trillion economy and probably be more. And the number of listed companies on NSE probably, which were about 130, 135 in 1995, are there, which are about 200, 2,800. Now, over the years, what we've seen is that India remains a very bright spot, and it continues to be a bright spot. And if we look at the GDP projections, in fact, World Bank again last week gave up another support in terms of how we are expected to grow, but largely we are in that line of 6.5%, 7% over the years. And when I kind of look back in terms of how this growth will help us to achieve that 7, 8, 10 trillion economy, it also is important to understand what is important for us to do in capital markets as a role, as an exchange, uh, to kind of facilitate more and more participation. Now, I think Harish ji and Dipesh ji again mentioned in terms of what are the factors which are driving growth, consumption. We have had the GST too, which has again fueled a lot of participation or consumption in that sense. But if I kind of completely say how is it benefiting and where are we in terms of NSE participation? See, we have about 120 million unique investors. Okay, which basically means that we have these many retail participants who are participating in India in the capital markets, with almost 230 million user accounts. What does that mean? Mean is that 1 in 4, basically 25% or 20 to 25% households are participating in that growth, and this growth has been about 7.5%. Now, why this is important is also because as these investors come in, as these investors start participating, and if I put that number in perspective in terms of what is the median age of Indians actually, the workforce, that's about 29. So when we kind of combine that and say, okay, if these many, million participants are already in the market, they are, the youngest, uh, working population median age at the young, what we see is that they will all come into the financial markets and start participating. What does that mean for investors at large? is that you will have a lot of liquidity, both from a perspective of users who will come to the market and participate. And one of the interesting things that we need to take care as a market which is attractive is that probably about 5 years back, the average age of investor was somewhere around 44, 43. That probably, if we look at in the last 6 months or last 1 year, has come towards either higher 20s, which is 28, 29, or even lower 30s. So which is very, very, dramatic shift. What we also from the exchange know is that we have participants from almost 99.85% of pin codes cover. So we have participants from all over the place who are participating in India now. And I'll come to more trends in terms of how the capital markets are evolving in India. But where does it take us, from a perspective of NSE, and how NSE has been able to capture that growth? Now, NSE was, India's first digital public infrastructure company. In fact, it was the first fintech. We were the first exchange to be demutualized, which means, you had certain set of criteria who could, in terms of who can become a member. It was not only limited to or restricted to certain participants. We were the first exchange in India to have an electronic trading. And, subsequently, we also had the first clearing corporation, and we were the promoter of the first depositories. Now, what that has really helped us to achieve is that we've been able to create an infrastructure which is end-to-end automated, which basically helps you guarantee a trade, clear your trade, and be confident that, if I'm trading on NSE, it will be a very seamless kind of a transaction. Now, to give a perspective again in terms of what kind of transactions we do, we, on an average, sometimes we process about 20 billion orders, messages per day, which is about 6.5 hours, and we settle about 250 to 300 million trades. Now, this is important from perspective to understand how robust the technology is, how safe the technology is, and how probably it will also help us to leapfrog when you will have almost double the number of investors in the coming time. And from that perspective, NSE remains, the gateway to the Indian economy. Now, just to also add some numbers in terms of how the infrastructure is. So we have about 17,000 plus servers. We have about 2,000 plus full rack equivalents of servers. We have about 30 plus petabytes of storage. And the clearing corporation that we have is rated. It's a AAA rated clearing infrastructure, clearing house. And in addition, we have a core settlement guarantee fund, which is about $1.5 billion. Now, putting all together in terms of the infrastructure that we need to support such a growing economy, we always keep working every day to make it more scalable, more lean, and more efficient. And when we say what it is yielding us, in terms of, if we see over the last 5 years, largely, we have seen that the local participants now, the actual retail participants, own more than what the foreign participants own in terms of the ownership of the companies of the listed on NSE, which has also helped us create a lot of wealth creation, right? And when I kind of say, okay, why do you want to invest in India? And this actually is going to come to that direction, is because, Nifty 50, and it started almost 29 years ago, where it has given a return of about 11.5%, and about 8% in terms of USD. So dollar terms, it's about 8%. Rupee terms, it's about 11.5%, and which are similar to that of S&P 500, and are probably, gold has run up in the recent time, but that is almost comparable to gold. So from a perspective of the India growth story, so 6.5% is something that we're looking at. We are at that potential inflection point where we will leapfrog into a larger economy. When we do that, we will have to create an infrastructure which will be sustainable for more people to participate. That participation is obviously coming because your median working age is much lower. The average age of participation in the market is also going lower. So it remains a great market. Now, what does this also mean is that while you will have participants coming in, you will also need more companies to come to the capital markets and raise that capital. So again, from a perspective of what are the opportunities in India, we did about 268 IPOs last year, raised about $19.5 billion. We were the largest exchange, globally, in terms of the fund mobilization. And we have similar expectations in terms of going forward. If India becomes a 8 to 10 trillion economy, you will probably require more than number of double than what we have on present to come. So there will be also a supply of good companies or companies which will come into the market, raise capital, and probably also create a shareholder value. Now I'll probably now pivot in terms of this we have covered. Now I'll tell you in terms of why I was talking more about India and how GIFT City helps us. So while GIFT City, obviously, like Dipesh ji and Irfan ji and we all know, is basically a window where global participants and investors can come and participate in the India growth story. From our perspective, it is our endeavor to provide that capital market for you, where you can come and participate. So right now, we have NSE IX. Now NSE IX has been doing a lot of business over the years since it's come. We have had a cumulative turnover of about $1.15 trillion in the last year, and on a particular day we had the highest turnover of about $22 billion. Now I'll also come in terms of what are the products, how are you participating, and what it is different from an India perspective. So while I'll not go into the fund structure or the structures that Irfan and Dipesh ji and other speakers have already spoken about, but I'll tell you in terms of what you can do in GIFT. And subsequently, as we have more webinars, we can have a more detailed drill down in terms of what opportunities are there for us. So if I look at what product and services that we have on the offer for the participants, so we have obviously equity indices, we have single stock futures and options, we have fixed income derivatives, we have currency futures, we have a debt securities market, we have an ISX platform, we have direct equity listing, which probably will happen and start going happening in some time now, which will again give us a boost in terms of how the markets grow. And the most important aspect is the NSE SGX Connect, which basically means the GIFT Nifty, which is the most traded product, is now trading on scale. Now you can obviously participate as earlier that if you were participating. So if you were participating on SGX Nifty, you still can participate on GIFT Nifty. If you want to directly participate, you can become a member. And if you want to, if you don't want to be a physically present member, there are options for you to be a remote trading participant. I'll just come to that. Before going that, I'll probably tell you why, and how the market at NSE IX is different from let us say an NSE.
Rohit, sorry to interrupt. I think we got running out of time. We got other next
Sure.
speakers on the webinar.
I have just I'll just take
2
a minute.
minutes.
Yeah. So in terms of, we have a single platform. It's a dollar denominated exchange. We have longer trading hours. We have pretty easy access to how you can participate, and the transaction costs are also lower. And this probably is in terms of how you can participate. But that was a simple, a small snap, and how the whole India story is kind of also reflective of how you can take and participate in GIFT, and through GIFT you can also participate on India. If you have more questions, you can obviously reach out to us anytime, and subsequently we can have a detailed chat on that. Thank you so much, and I'll pass it on to the next speaker.
Thank you, Rohit, for those valuable perspective on how technology and innovation are transforming India's market access for the global investors. Now we welcome Mr. Jay Kothari from DSP Mutual Fund to share about how long-term wealth in India's growth and fastest growing economy can be ample. Over to you, Jay.
Thanks, Ailesh. Thanks, Vipin ji, Harshad ji, India's High Commissioner in Australia, and Dipesh ji from IFSCA, and to all my fellow panelists. It's a pleasure to be back, with IG Growth for the session, this time virtually, and I'm sure this is not the last time we'll have many more. So thank you for the opportunity. Since our earlier speakers have put a very strong foundation in terms of the overall macroeconomic, I'll just maybe focus on microeconomic, that is bottom up, and how you take exposure to this. And I'll just put a perspective in terms of preempting a lot of questions in terms of earnings growth, valuations, growth going forward, and also in terms of where India has been over the last 5 years, 10 years, and even over the last 12 months, which it hasn't done very well, and how new investors can look at this. So let me start by saying that for the last 5 years, MSCI India had delivered 12.4% dollar returns versus the MSCI emerging markets at around 5%. So therefore there was an outperformance, and even in the 10-year basis there was outperformance of 300 to 400 basis points. We've given some of that away over the last 12 months. Just to give you a sense, MSCI India is down 12% USD terms versus MSCI emerging market, which is up 15%. So there's a 27% or a 30% underperformance versus emerging market in the last 12 months, which itself should kind of ring a bell into our minds that, the underperformance is playing out, time correction is happening, and hence investors who have waited on the sidelines to invest into the Indian equity market should certainly keep their powder dry to, be ready to invest into the Indian market, because you're not investing for the next 1 year, 2 year, 3 years. You're going to be investing over the next 5 to 10 years, and hence we'll come to why there's an opportunity. So that's a quick preamble on that. YTD also, whether it's India, which is 0% versus Korea, which is up 50%, emerging market, which is up 25%, and US, which is up 15%. So we've underperformed that. In terms of the valuations, we completely understand that a few of the sectors are trading above their historical peaks and are expensive, and hence you need to kind of invest through active managers who can pick and choose their stocks which they are the most comfortable with. So one has to be extremely stock selective, and let me tell you our view on that. So we think we want to focus on sectors which are bottom up, focused on mass consumption, whether it's two-wheelers, whether it's travel companies, QSR companies, that's quick service restaurants, or durable companies, or value retail, a few of the power transmissions, few of the data centers, semiconductors, affordable housing. So these are the sectors which generally, one could look at over the next 5 years. Coming on to the actual sectors, autos looks pretty good because of the GST cuts. And then, our few of the speakers did mention about the GST cuts. I just want to give you a number to put into a perspective, that GST cuts plus your tax cuts plus the gaming ban which happened in India. Not sure if many of you know, but gaming, which was becoming 30,000 crores was getting spent on gaming. All that money is now back in the system. So we think autos, consumer, technology, because of its underperformance recently and the fear of AI, look pretty good. A couple of sectors which are continuing to remaining slightly punchy as far as valuation is concerned remain capital goods, a few of the PSU banks, a few of the utilities, because of its general issues, and hence we are overweight on banking and financial sectors, consumer discretionary sectors. So let me give you 2 points on each of these sectors. Banking and financial sectors, generally it is trading at averages or below its averages as far as valuation is concerned. And in a market where you're not finding any opportunity from a valuations point of view, BFSI looks extremely attractive. Number two is consumer discretionary. Again, with the mass consumption and consumer discretionary spend, which will happen, will help that consumer discretionary sector because of the tax cuts and the GST cuts, which should help. Industrials, healthcare, telecom. These are the sectors which also look good from an overall, whether it's hospitals, whether it is the generic drugs, or it's even the US generics which were under fire, but then later got clarified that they're not going to get impacted. So those are the sectors which we remain kind of overweight on. As far as the view on the government is concerned, that government is trying very hard to boost consumption, which is the need of the hour, which will help in the economy going forward. Number two is that generally, most of the macroeconomic issues are kind of bottoming up, and whether it's monetary easing, whether it's fiscal, fiscally government is trying to boost consumption, etc. So all this put together, plus the monsoons have been pretty all right. Interest rates have kind of got cut. So incrementally, we should see all this following through the earnings growth of companies. So that brings me to the earnings growth. Earnings growth for FY26, that is the financial year we are currently in, that has got slightly downgraded to 3 to 4%. So we are now expecting a 7 to 8% earnings growth for FY26. And the same for FY27 is expected to be around 17 to 18%. And I want to spend maybe 1 to 2 minutes on this, that in 2023, there was a classic case where, index was trading exactly what it is trading now at 20% or 20 times forward earnings. And a lot of global investors and India investors said that, index is at 20 times. So should we invest or not invest into the market? And at the end of the year, the earnings growth came at 20%, and the markets were up 23% those years. So, that kind of clearly tells you that one should not only focus on valuations, but also on earnings growth. And we believe over the next 3 to 4 years, earnings growth will remain very, very steady. And one should certainly focus on that. Lastly, as far as, if I were to just maybe show one slide, which I had showed even when I was in Australia, please give me a thumbs up if you can see that chart. Okay, perfect. Thanks, Rohit. So, in terms of the overall, Vision 2030, usually what people kind of focus on is the near-term kind of opportunity. But let me just kind of zoom out and give you a bigger picture. Is what would India look like in 2030, and hence why one should kind of focus on the Indian market. Number one is, on all the variables which you see on our screen probably doubles from here on, whether it's GDP, which will go from almost $4 trillion to maybe $8 trillion, equity market cap, goes from maybe $5 trillion to $10 trillion, assuming our GDP is $8 trillion. And even if it's 150% market cap to GDP, this could be much higher than even $10 trillion. IT exports will kind of almost double from $200 billion to $500 billion. Credit to GDP will kind of go from 57% to 100%. Your household income, this is very important aspect, where 8.4 million households are there who earn more than $35,000 per year. That'll go to 25 million households. So you can just imagine, the overall impact it's going to create to consumption in India. Energy demand will also kind of double from here on. Retail market will go from $850 billion to $1.8 trillion. And exports as a percentage of global exports will go from 2.5% to almost 4.5%, which tells you that our GDP per capita, which is currently at $2,400, and all of you sitting in Australia are at around 70,000 GDP per capita. So when people ask us that has Indian market done what it has to, and we say it's not even started, because over the next 5 years, 10 years, 15 years, we are not even 1/30th your size right now. So even if we become developed markets by 2047, we are sure to kind of go many-fold from here on, and hence one shouldn't kind of miss this opportunity to invest into. Lastly, obviously with HDFC is also here, DSP is also here. Through IG funds, we've got the opportunity to kind of project our strategies in the Australian market. And I think, we are well positioned to take advantage over the next 5 to 10 years. So I'm conscious of time. I'm on the 9th minute, so I thought let me stop here if there are any questions, or Harshad ji, Vipin ji, or Elish, anything else which you would want me to cover.
I think, thank you. I think it's been wonderful. In the interest of time, we have to move to the next speaker, but we have many questions to ask later.
Yes.
Yes.
Thank you, Jayji, for highlighting about India's micro story and India's growth story, and how an active management and create a future for investors well. Right now, for the next, we can have Mr. Aravind from HDFC. He's the head of international business at HDFC EMC. Over to you, Aravind.
Thanks, Elish. Is my screen visible?
Yes.
Yes. Thank you. Thank you for all joining in for this particular call. Happy Diwali to you and your family members. And it's my pleasure to be part of this eminent panelist. So as you can see, the festive mood in India is extremely high, and my attire reflects that. So I thought, let me purposefully dress up that way to reflect what is the mood in India now. Right. So our panelist covered more on the macro aspect of it, how India growth story is, and how the diplomatic ties between India and Australia are emerging. And my dear friend Jay also covered on the economy part of it as well, in terms of which are sectors which are doing well. I'll probably take a middle path. Quickly, no need for introduction about HDFC. Is my screen moving? Yeah. So HDFC Group as it is, HDFC Bank is the parent, and we are about $180 billion market cap is what HDFC Bank is, the top 10 bank in the country in terms of market cap. And asset manager, as HDFC Asset Manager, we are top 3 asset managers in the country. We manage more than $100 billion of USD at about $155 billion of assets under management as per AUD. Right. So quickly, economy has been well covered, but I wanted to purposefully touch upon the key drivers that is driving the India growth engine. The 4 drivers which we feel are the key to our economy are demand, digitization, demography, and democracy. These are the 4 pillars which are driving our economy. Purposefully, I put in this particular chart of GDP. So if you look at this particular chart, which came in about 2 years back, projected India to be the 4th largest economy by 2027. But as we speak, we have already moved to 4th largest 2 years in advance. In 2025, we became the 4th largest economy. As we speak, by 2029, the estimate is that we will be the 3rd largest economy. So as you are aware, our economy size is about $4.3 trillion. Imagine on a real GDP basis, if we continue to grow at 6.5–7% for next 3–4 years, every 4 years, India will produce one Saudi Arabia. Saudi Arabia economy is about $1.2 trillion. Every 4 years, we will produce another country. That's the size of opportunity what India is growing at. At the same time, the right-hand chart of IMF, this is the July 2025 chart, which shows that India will be amongst the largest economy, will continue to be one of the fastest growing. The initial projection was 6.3% was the growth projection for this year. As we speak, yesterday IMF revised this 6.3% to 6.6%. And today there was in our local newspapers, business newspaper, there was an article by S&P Rating saying that India can grow at 7% for next 3 to 4 years consistently. But most importantly, what we need to focus on is where, as I was talking about the demand, where the demand of the economy and where the growth is coming in from. As you can see, the growing population, the work age population predominantly between the age of 30 to 60, India will add about 152 million new workforce during this particular period by 2045. At the same time, China will lose about 116 million. So the new workforce, new demand is going to come in from Indian population. At the same time, among the largest Asian manufacturers, you can see the labor cost of Indian manufacturing is amongst the lowest. And work age population, we are ranked number 1. STEM graduates, which are science, technology, engineering, and mathematics, India stands as number 1. And India also stands in terms of English-speaking population to be number 1. At the same time, as Jay also touched upon, the household income, which is extremely critical, right? So this is a Morgan Stanley study came out in 2021. Between 2021 to 31, as we can see, 26% of Indian household are about $10,000 of household income, which will move to 53% by 2031. So good amount, more than half of Indian population or household population is going to be earning more than $10,000 as a USD. What is driving this is a gradual shift from agri-oriented economy to a manufacturing. At the same time, we have technologically advanced in terms of agriculture. Agriculture remains core and it is very important. The right-hand chart shows that countries which are low agri contribution in terms of economy are high income in terms of per capita GDP. countries which have a high agri contribution are relatively lower in terms of per capita income. India are gradually moving towards a low agri population in terms of number of population involved in terms of agriculture. But technological advancement is ensuring a higher production of agriculture, and those excess labor who are in agriculture are moving towards manufacturing. That is going to propel our per capita income growth as well. But three things which are driving in Indian lifestyle or Indian demand is, first is the increase in the life expectation, increase in the life expectancy, and increase in life expenses. All these three factors are driving the demand. I would like to repeat again: increase in the life expectation, increase in the life expectancy, and increase in the life expenses. All these three factors are driving Indian consumers and the income also. At the same time, it is extremely important for us to understand there are quite a few business people who would be part of this particular forum. Very important thing is that, okay, India is growing. We know that India has a long-term growth story. How do you participate in this India growth story is very important. The effective way of participating in India growth story is through equity as asset class. At the same time, when we talk about real GDP growth rate, we talk about real GDP growth rate of 6.2%, 6.3%, 6.7% or 7%. Many of you run businesses. If I have to draw parlance to an India growth compared to a corporate balance sheet, as you all know, the corporate balance sheet revenue number has two components. One is the quantity change. Second is a price change. The quantity change, how much we produced last year, how much we are producing this year. The price change, at what price we produce that quantity and what price we are producing today. These two components adds up to a equity return. As you are aware, in India, the real GDP, what we always talk about, the 6.5%, 7% is nothing but a quantity change. How much we produced last year, how much we are producing this year. That is only one part of the story. The second part is that inflation gets added. That is the corporate balance sheet. So Indian corporate balance sheet, India as a corporate has been growing consistently between 11 to 12% on the balance sheet level or at the top line level. So you have inflation of about 4-5% plus the real GDP growth rate of about 6.5-7%. Both together, India has been consistently growing over decades between 11 to 13%. So that is the first stack. So India growth is actually the real GDP growth rate plus inflation, which is 11-12%. Better managed companies or listed companies tend to grow by another 1-2% more. That is where Indian equity over a period of last 30-40 years has delivered 14-15% as a return. Better managed fund houses like HDFC, like DSP tend to deliver another 1-2% more of alpha because of the active fund management. That is where funds in the last 30 years has delivered 15-17% kind of a return. So three stacks. India is growing at 11-12% of nominal GDP growth rate, plus listed companies, better managed companies, well-managed companies come for listing. Those companies tend to grow by another 1-2% more, which is between that 12 to 14%. Better managed fund managers and better managed fund houses tend to deliver another 1-2% of alpha. That is the Indian stack of return what we are talking about. So, but at the same time, we all know India or any equity as asset class is short-term and volatile. I mean, in short term, it is always volatile, but in the long term, it reflects the growth story of what the underlying company is. As you can see, right side chart, India Sensex, which you all know or familiar of, started with a base of 100 in 1979. As we speak, the number is about 83,000. Meaning 100 has become 83,000, meaning if you are just invested into Sensex at the index level of 100, today the number of times it has grown is about 838 times at a staggering phase of about 15.5% CAGR. This is only the index. Better managed funds has delivered better return. But in short term, obviously there will be years of losses, there will be years of stupendous profit, but over a longer period of time, it tends to converge. The minimum return, maximum return, and average return starts getting converged, right? So this is an interesting chart. As I said, from 1979 when Sensex started till 2025, Sensex has given about 15.5% as a return. Gold as asset class has run up recently, but has given about 11.5%. Bank FDs in India has been about 8%, right? In countries like Australia is far lesser. And the inflation is about 7.35 for the long-term average, but Indian inflation is about 4.5% today. That's a projected inflation rate. But having said that, we always, as investors, tend to look at short term and we tend to time the market. What Warren Buffett had beautifully said, time in the market beats timing the market. You don't tend to time, you should not time the market, but time in the market is much more important, right? So same chart, if you look at it, the above chart is the Sensex data from 1990 to 2025. This is a 35-year of data. In 35 years, you typically have about 7,000 trading days, about 200 trading days in a year, about 7,000 trading days. If an investor had stayed invested throughout this 35 years, the returns would have been about 14% CAGR. As I said, it is a market return, not the fund return. Funds have delivered better than that, but market return would have been about 14%. But if somebody had tried to time the market, enter and exit, saying that this is the market has run up, I will exit now, I will come back again in the when the market falls down. And if they had ended up missing the best 40 days, what we mean by best 40 days is the best returns of, if I put the days in which the market has given the highest return, the first 40 days in terms of highest returns, for some reason when they time it, if they had missed being a part of the market of the 40 days out of 7,000 days is 0.5% of the number of days. Then the returns from 14% would have come down to 5%, right? So that's a significant miss. If you had missed the number of days, the critical days, that's where we say that enter through equity, but stay for longer. Warren Buffett had beautifully said, equity is a device for transferring wealth from impatient to patient. So this particular chart reflects that. And some of our funds, for example, our HDFC FlexiCap fund, which has a 30-year of history, same time during the last 30 years, if somebody had fully invested, is 18.96%. But if they had missed the best 30 days of our returns, then the returns would have come down by 5% lesser, right? So the other way of participating through Indian growth story is systematically investing. As Jay pointed out, last 1 year returns has not been great, but we had a phenomenal run for last 5, 10, 15 years. This tends to be volatile. As I said, in short-term markets will also be always be volatile. But SIP is another great avenue, and IG funds have structured that both SIP and SWP as an option for you to invest. So over a period of time, for example, this particular fund, we are taking this as a case in example to cite how the growth story can be. Somebody who had invested at $10,000 per month over the last 30 years in a fund like HDFC FlexiCap fund, which would have invested about 3.6 million as a total investment amount, today would have been sitting at around 210 million in terms of valuation at a staggering 18.8% CAGR. And there's another very interesting chart. I will just spend a minute on this. The power of SIP also reflects in the power of SWP. So you invest for over a period of time and start withdrawing as a systematic withdrawal over a period of time. The first chart is quickly we would like to focus on, which is a Nifty 50 chart from 1995 to 2010. So if somebody had done a 15 years of SIP of doing $5,000 per month, you had invested for every month for first 15 years from 1990 to 2005. 1995 to 2010, $5,000, where you would have invested $900,000 as a total investment. The valuation of that would have been $3.72 million, right? At the same time, after 15 years from 2010 to 2025, if you kept withdrawing $10,000 as your monthly expenses to be met for the subsequent 15 years, you had invested only $900,000 over a 15-year period, but you would have withdrawn about 1.8 million. But the valuation after that was about 15 million. So that's the kind of power of SIP and SWP. This combination is being provided by IG funds as well, which we all feel that you should utilize. So with that, I will just come to the last slide of my presentation. HDFC's investment philosophy, as you are aware, what we always say is that wealth creation is not targeting the highest return, but avoiding large mistakes is extremely critical. So we look at fundamentally strong companies. We have a deeper understanding in Indian market. We are a financial conglomerate based in India. So we have very deep understanding of business, where to put in money, how to exit, and how long to stay invested. With that, I've taken a lot of time. I'll end with this. Thank you and happy investing.
Thank you, Aravind. Thank you for those wonderful insights into India's fund market. And as you mentioned, as Warren Buffett said, it's all about time in the market, not timing in the market. Moving now, I would like to introduce Harshad Kale, the founder and director of IG Fund, who would bring about the bridging of India's capital market via GIFT City. Over to you, Harshad.
Okay, thank you. I'm going to present about IG funds. I'm audible and can you see my slide?
Yes.
Okay,
Yes.
thank you. So namaste and good evening, everyone, and good afternoon for the people sitting in India or Dubai or some other parts of the world. It's an absolute pleasure to welcome you all to Shubha Diwali, the IG Fund webinar 2025. On behalf of IG Fund Australia, I extend my warm Diwali greetings to everyone joining from Australia, India, and across the world. I'm the lucky last speaker, so thank you for your patience and thank you for detailed presentation by all the eminent panelists and patience by the participants. I will speak how we can access this India's capital markets growth opportunity from Australia. So this Diwali, as we celebrate light over darkness and knowledge over ignorance, it's a symbolic of what we are doing here today, bringing clarity, and access to the India's investment opportunity from Australian investors. So, as I said, IG Fund was founded with one clear vision: to bridge the Australian capital with Indian growth story through transparent, regulated, and technology-driven platform. For decades, Australian investors have been limited access to the India, one of the world's fastest growing economy. There are regulatory barriers, tax complexities, operational challenges, and that kept the investors away, despite India being a $4 trillion economy with a double-digit earnings growth and thriving equity markets. So we're trying to solve the problem of India access through the IG Funds vehicle. At IG Fund, we decided to change that paradigm. We created a simple but fully compliant Australian license pathway connecting Australian investors, wholesale investors, directly to the India's top performing mutual funds, which are registered in GIFT City. So what makes IG Fund different from, we have combined the regulatory strength or technology and simplicity. So the investors can now invest in India without needing typical Aadhaar, a PAN, NRA NRO account, or complicated remittances structures in India. So everything happens seamlessly in Australia with local KYC, with local AML, and investment in Australian dollars based in Australia with your online portfolio tracked in Australian dollar in AUD. So moving on, as a platform, at the moment, we launched two funds. So on our IG Fund platforms, we allows investors to access the capital markets in AUD and Australian dollars through GIFT City registered feeder funds. First fund is our DSP and second fund is HDFC mid cap. So DSP gives you access to the large cap and mid cap opportunities, and these are some of the features about the DSPs. And HDFC gives the mid cap opportunity through the mid cap opportunities through the access to the mid sectors. So all these funds has decades of performance and global recognition. So IG Fund is a license in Australia with its own AFSL structure with an independent trustee, which is non-correlated capital, and independent registry, which is our NAM fund services. And they act as a custodian, as administrator of the fund. This ensures the governance, transparency, and investors' protections on every level of the compliance and investors' reporting and transparency. In essence, IG Fund is not just an investment platform, but it is a gateway to the India's growth capital built on trust, on compliance, and efficiency. As a strategic alignment with the bilateral trade between India and Australia, as a conduit between the export of capital, IG Fund initiative aligns perfectly with the broader partnership of the two nations and ECTA agreements. And we share the vision of both the governments with the deep trade and investment flows. We thank and proud to work with the High Commissioner of India's office in Canberra, Consulate General offices in Sydney, Brisbane, Perth, and Melbourne, IFSCA regulator in GIFT, NSC, and leading AMCs like HDFC and DSPs, and also support from AIBC. That all driving the India's emergence and global financial hub GIFT City access. We truly believe in India's decades of growth and will create a significant opportunities. IG Fund is honored to play a small but a very important role in facilitating the capital flows, investments that bridge between the two great nations. As we celebrate Diwali, let's also celebrate a new beginning of partnership, possibilities, and prosperity. On behalf of IG Fund team, I thank you all the partners, investors, and all our distinguished speakers today. We look forward to working together to make India a destination for the Australian investors. So happy Diwali to all. May this festival of light bring success, clarity, and abundance to all of us. Thank you very much.
Thank you, Harshad. And what an inspiring session this has been. Truly reflection of how collaboration between Australia and India is lighting a new pathway for growth and prosperity. On behalf of IG Fund, I would like to extend our heartfelt gratitude to all our distinguished speakers and, of course, for sharing their valuable insight and lighting the pathway for the future partnership. As we celebrate Diwali, the festival of light, let's also celebrate clarity, prosperity, and new beginning. Just as the light removes darkness, informed investment removes uncertainty, empowering our build a brighter future for financial together. Thank you once again to all our guests, partners, and IG Fund community for joining us today. Please stay connected us through our LinkedIn, and if you have any questions, please put us through at invest@igfunds.com.au. From all us at IG Funds, wishing you and your family a very Shubh Deepavali. May your investments shine as bright as lamp of Diwali. Thank you. Thank you, everybody.
Great. Happy Diwali. Thank you very much.
Thank you, Harshad. Thank
Happy
you,
Diwali.
Dipesh. Thank you so
Thank
much.
you. Thank you,
Vipin,
everybody.
Alex,
Happy
Aravind.
Diwali.
Happy Diwali.
Happy Diwali. Thank you, everyone.
Thank you.
Thank you.